Hello everybody. So 5 months ago I did a pretty extensive, pretty elaborate research video about the UPS stock, and I just decided to check it out again, just looking at the fast graphs, which we will look at soon. I was again intrigued, again curious, and I kind of refreshed what is currently going on with the business, and maybe it's a better buying opportunity. Also, it's about 10 to 12% below the price it has been when I last analyzed it. So I thought maybe it's a better entry price, which I did conclude in my previous video that I'm waiting for a better entry point because I would love to own it, but for the right price. So I want to share my conclusions and what I found out in this video, and maybe even manage to make it a bit shorter this time. So let me switch to my screen and show and talk about UPS a little bit. So UPS, just to give a refreshment, is a very long time business and a very stable business. We see it has been growing its earnings for many years now. We see this downtrend during the great financial recession. It is a cyclical business and will be affected by a downturn in the economy. And it was historically trading for all this long period that is currently on the graph for a multiple of around 19. But we see that even before COVID, there were about 2.5 years where the valuations had suddenly gotten lower, and this reflects kind of an pessimism that was then with the stock, and just by checking it out, I was also curious. I don't think I talked about it in my previous video, where the headwinds were already clear with UPS, where Amazon was phasing out of the business. Amazon is comprising currently 10% of the revenues of UPS, and we'll talk about how that's going to change soon. And Amazon is slowly but surely building its own network and relies less and less on the services of UPS, and it is phasing out, while UPS also faces a lot of competition from other providers, of course FedEx and USPS, but also the fact that Amazon is expanding its own network and offering services to SMBs, also small medium businesses, and also the entrance of Temu and Shein, which gained a huge market share, especially in the United States, but not only, and they pose a serious threat also to the business of UPS, where they could also build their own networks or rely on other networks, and definitely reduced from the packages that UPS is handling. So those are some of the headwinds. The other one was the increasing labor costs, because the half of the employees of United Parcel are unionized, and there was just then a renegotiation of a new agreement with the union, and they negotiated a pretty big salary hikes, so the labor costs of UPS were expected to go up and the margins to go down. So this is what UPS was facing entering COVID, and then COVID hit, and of course UPS was one of the big beneficiaries from the COVID boom. Everybody was staying home and ordering packages, everything they needed home, and UPS really enjoyed from that and had this huge spike in earnings and in revenues and in margins and in everything. And with that followed a huge spike also in the dividend, where they increased the dividend by 50%. I'm recapping some of what I said in the previous video, where they increased the dividend by 50%. I again set out, I don't get this move, to check what was the rationale of the management then to do that, and it seems like maybe the management thought that those trends, this change in the consumer behavior due to the lockdowns, is a kind of new norm, a new shift, a new paradigm in the market, where the changes now are going to be, some of them at least, permanent, and the UPS kind of probably failed to figure that it was absolutely temporary, because after COVID everybody has just returned back to their previous normal life, and the UPS's revenues trended down, back down, while their earnings with the elevated costs have slumped even more, and with that came the higher interest rates and inflation and all kind of headwinds that UPS is also facing, and just the tougher macroeconomy, which is definitely affecting UPS also. As we said, it's pretty cyclical business, pretty sensitive to the overall state of the economy. And so we find ourselves currently where the earnings of UPS and their volumes and their revenues have been trending down since the bust after the boom of the COVID began. But now things seem to be turning a little bit around. So what is going on currently in the business and what has changed since I did my last video is, first of all, UPS has announced it's going to phase out of Amazon. It's going to reduce half of its business with Amazon. Again, Amazon comprises 10% of its earnings, of its revenues. I'm sorry, not the earnings. The margins of Amazon are lower. So 10%, 11% of its revenues. And now Amazon has decided, and Amazon was phasing out of UPS, as I mentioned, anyway, but it was doing it at its own pace. But now UPS has decided to cut some of this business on its part, because the rationale is that the margins are very, very low with Amazon, where they are able to negotiate very low prices, and kind of the type of packages and deliveries that they are outsourcing for UPS are the most cheap ones, the most unprofitable ones. So UPS has decided to phase out of it. So it's gonna reduce its revenues by about maybe $5 billion annually. We'll see by the end of 2026. So that was the big development, where they promised that the margins, it will improve the margins. But personally, I don't think that's good enough of a reason of its own. But I'm not there. I don't know all the nuances, and here really the nuances are important to understand how correct is this decision, because just phasing out of a business because it has a lower margin than your other business is obviously not always right. Usually, on the contrary, we encourage companies to enter new businesses, even if the margins there are lower, as long as they still have some kind of acceptable return on invested capital. So the fact that the margins are lower than other products doesn't mean it's a bad business and you should get out of it. But I'm sure there were more considerations and more nuances here. But I don't know which they were, and I cannot really judge. I'm not saying that necessarily UPS did the right thing. Maybe yes, maybe not. I don't know. But that's about Amazon. And the other thing is that it won a big contract with USPS, a contract that belonged to FedEx for many years, and now UPS won this contract, so it's gonna add about, I think, about $2 billion in revenues from now on, so it's nice. And another thing that I was really pleasantly surprised with UPS was that Temu and Shein, which posed kind of a risk, they still do, they pose a risk and competition for UPS. But UPS has partnered with them, and we don't know for sure how much are we talking about in terms of volume and in terms of revenues, and of course in terms of margins also. But it seems that UPS has offered its services to Shein and to Temu, and Shein and Temu are now using UPS also in the United States. So UPS is managing to capitalize on that. Again, we don't know how material that is and how temporary that is, because if with time Shein and Temu will be able to leverage other partnerships they have, and or expand their own network in the US, so they might again phase out of UPS like Amazon did. But for now, it's really nice to hear that UPS is not only threatened by Shein and Temu, but is also working with them and manages to profit from it also. So those are the kind of big developments in terms of the revenues. The other thing is that UPS is working on efficiency currently, and it is, I'm guessing that the Amazon thing is a part of its efficiency, but also it is investing to modernize its systems and to add RFIDs and all of that, and to be more efficient. In short, we don't know how that will, of course it needs to do that anyway, no matter what is going on. So they kind of trying to improve their margins. What I would say about the efficiency is that usually what I understand is that in the logistics universe, efficiency mostly comes from scale and volumes. So now that UPS is reducing a bit its volumes, now again, it's all in the nuances, I'm not sure, but as it is reducing its volumes with Amazon, it might lose efficiency and lose scale, economies of scale. But also it's gaining other business, so I'm not sure, I'm just mentioning it. So in terms of the forecast, just to mention that in my last video, the estimates were much more optimistic for 2025 before 2024 was reported still, and I said back then that we cannot rely on it, and here we see that eventually, yes, they're not resuming their growth again this year, and this year it's gonna be pretty much flat. And in terms of the revenues are expected to be down still this year. Here we see the estimates of revenues, but we also see a bit of improvement when this is the top line, the revenues quarterly, year over year, and we see that from December 2022 there was a downtrend, and it went down and down, the revenues, and then it was still negative, but a little bit of improvement has begun, and this is where I recorded my last video when it was just by 1% still down. And since then we did see the revenues again turn positive year over year. Of course, the comp is this September 2023, where revenues were already depressed, but again, we still see this improvement, this reverse in the trend, although since then in the last quarter we see that there is not more improvement and it's pretty much flat. So just to mention really quickly on capital management, it hasn't changed from my last video, but just to give an update if someone watches this for the first time, I'm guessing most of you. So the debt of UPS is surprisingly very manageable for a capital intensive business in these times, but the debt is around 25 billion, where the operating cash flow we see that was pretty much stable since 2018, around, I mean, it wasn't stable, but it was at the same level of around 10 billion. So I'm not saying it's a low debt, but it's fine, it's okay, and it does has a credit rating of A from Standard & Poor, and in terms of the return on invested capital is very high, again, for a pretty capital intensive business, not the worst, but still very labor intensive business, yeah, we see that the return on invested capital is steadily above 10%, very, very impressive. So UPS is definitely a high quality company, but here comes the but. My problem with the UPS still is the three things. The first one is the dividend. The dividend is currently at 5.6%, but it's absolutely unsustainable. Again, because they did this crazy hike by 50% during COVID, and now their revenues are down, their cash flows are down, and they're pretty much at almost a 90% payout ratio here out of free cash flow. We can see it's very tight. We did this calculation in my previous video, but we can just see it here on the graph, very tight. It leaves them almost no cushion for the free cash flow to invest in anything else or to do the share buybacks that they used to do. And just to mention that the company was aiming for a payout ratio of 50% before COVID, so where are they now? And when this 50% target is, they're not getting there unless they cut the dividend anytime soon. So my thoughts on the dividend is that they will fight hard to retain it, because obviously they have this history now and this track record that they will really would love to retain, and they will fight for it. And even if there is kind of a tough times, they might even take on more debt and pay the dividend and still manage to increase the dividend. I think that was the case before with them, if I'm not mistaken, like here. And here, okay, that was just 1 year, but I still think if we are heading into a tough economic times, if a recession hits, they will have to cut the dividend. And overall, I think I would love to buy UPS after a downturn in the economy, because right now they are facing some headwinds, but if we are entering currently maybe a recession or kind of a slow economy, kind of a bear market in the even a sluggish economy, UPS is definitely going to feel that, and it could definitely go much lower from here in earnings and in its stock price also. So that would be really the point where I would love to own UPS. So even if I would put some kind of a position in it today, it would be a very, very small one with the intention to increase it when the time is right, when it usually is it's not a crazy cyclical company. Obviously, it's still profitable during a big recession, and it has a pretty stable earnings track record. It's not the most cyclical company, but it is cyclical. So the cyclical company I would prefer to buy coming out of a recession, coming out of a rut. So for me, a small position would be the most that I would be willing to commit to it currently. But another headwind that it is currently facing are the tariff wars, where obviously UPS is affected by it very much. So I think this was one of the reasons also for the low valuation, where the tariff wars with China have already begun, I think, before COVID, and now of course we know the tariff wars with maybe Europe and Canada, and we shall see what will materialize and how. But it's also a big threat, and maybe shorter term, but still a kind of a threat for UPS. Although maybe the world is more going towards kind of a deglobalization, where it's not something temporary, where countries will become a little bit more isolationist in terms of their economy, maybe not just the economy. The United States is definitely considering that and playing with that thought currently. So that could be also a long-term headwind for UPS, which obviously relies on people not buying locally, right? So it could be also a long-term headwind. And another thing that is also long-term in my mind is the competition, where I don't know, just UPS, obviously it has a moat in all its infrastructure and its logistics network, but still it kind of feels to me like it's operating in a kind of obviously highly competitive world, where it doesn't really have a big advantage over its competitors. I mean, when you order a package, you don't really care if you get it by FedEx or UPS or Amazon, and businesses also, when they're looking for a third-party logistics partner, they're obviously going to look somewhat at quality, but I'm not sure that FedEx or Amazon, or if there are other options, maybe even use a USPS, would offer something so much different in terms of quality. So UPS doesn't really has that advantage, like it's a kind of a premium product or something special to offer, where it could maybe have some pricing power or a kind of leverage over its customers, like other companies I like and own. So that's also kind of where it doesn't really control the price, and it faces all this competition, and it really feels for me like it has nothing special to offer. So that also kind of worries me, where it's going to be very hard for UPS long term to keep its market share and to gain its market share. Couple that with the headwinds from phasing out of Amazon and the tariff wars and the possible downturn in the economy, which will definitely affect UPS. And I'm completely not a huge fan of UPS at current price still. Of course, it has a few tailwinds also. It has its long-term growth that stems from the expansion of mostly the expansion of e-commerce, mostly currently globally, more even so than the United States, where the growth is there, but it's more slower now. And the UPS it has, I think, a 20% if its business is in international. So there, the growth in e-com is really still high, and UPS stands to gain from it. Also, it has the healthcare sector, which is growing very quickly for it, and it provides a suite of services services for healthcare logistics services for healthcare companies. So that's also a headwind where there is a very nice growth there, and also just the natural growth of the population in the United States. Again, I think around 80% of its business is in the United States, so it is affected mostly by trends in the United States. So it does have a few tailwinds for the long term. If someone says, I'm entering at this point where 15 PE, we'll talk about valuation in a minute, into UPS, and I think long term it will do really, really well and continue to grow, and it will revert back to its 19 PE eventually. And for now, I'm locking this dividend. I understand, but for me, which my time horizon, my investment horizon is a little shorter. I'm looking at the few next years, which have really still low visibility. Maybe I'm kind of repeating my same message, which probably hasn't changed from my last video, where things could definitely get worse from here for UPS, and for a company that is currently, we don't know how much of a growth it's gonna have in the next few years, maybe no growth at all. 15 PE is not so cheap. It's absolutely normal evaluation. I could even say it's a bit pricey maybe. Again, for a company that right now we don't know if and how much it's gonna manage to grow in the next few years in terms of its revenues and its profits and the competition, and also the higher risk of a recession now, yes, no doubt. And also the perspective of a dividend cut, which could also obviously affect it for the worse, the price, at least the price of the share. And I probably would be really interested in it after they cut their dividend, maybe in a year or two, because usually that's a good point to buy, where things start to improve from there, especially in the balance sheet department. But we'll see. Right now, at this point, again, what I see is a low visibility for the next few years, a 15 PE, which I think is not cheap at all. And I have no confidence that in the next few years UPS will manage to retain even the earnings it has right now, especially with the perspective of a downturn in the economy. And therefore, it might take years for it to revert back to this blue line, to this 19 PE. So I don't think it's a good entry point still. I concluded in my last video that I would be drooling over it below $100, and I think it's still true. It still holds true. I would like to see a lower price for me to buy a really bigger position. And right now I'm contemplating maybe a small position. Just for me, it just feels a little bit right for my portfolio, because it is a high quality company. It's not going out of business, and it has a high credit rating, again, manageable debt, high return on invested capital. It's a higher quality company than a lot of companies that I own, and it's also a kind of a diversification in its business, in the sector itself, where I'm very heavy currently in my portfolio in pharma stocks and in packaged food stocks, and I really want to diversify from it. And the reason I did that was because those are recession-proof kind of stock, and I was kind of trying to build a more defensive portfolio. So UPS is definitely not defensive. It's not the worst also. We see that even in 2008, yes, it had these two bad years, but then it rebounded and recovered really nicely. And also its stock price, it's not the worst. There are companies that much more cyclical than this one, but still I feel that this is a kind of company I was avoiding until now because it's more sensitive to a recession. But now I feel that maybe just to buy a small position now and hold it really long term to enjoy that dividend that I think is high probability will be cut, but even after it's cut, it's going to be an acceptable dividend yield for me, on the lower range, but still. And long term, I think someday the company will recover. And for now, I will just enjoy the dividend and have that balance in my portfolio. And when it does, and if it does trade more down, which I think still is very probable to happen in the next few years, I could always buy more. So I don't know. I haven't decided. This video just helped me to think. When I decide decide, I maybe add a comment below what I've decided, if I want to place just a small position or avoid it completely for now and wait for even better entry price. But yeah, I kind of wanted to review that because I don't know, this graph looks good, it looks intriguing, where it's not often that you could catch a UPS at a PE of 15, except those few years before COVID. But we see that historically it was always trading at much higher valuations, and historically a PE of 15 has been a good entry point. So it does look interesting, but no, I think there is a good reason it is trading currently here, and still I think in this valuation there is a kind of a premium for the kind of a blue chip company that it is, because just looking at the fundamentals, I think a PE of 11, 12, 13 would be even more suitable. So yeah, that's it about UPS. I hope I made it coherent and clear, and I'll see you in the next one. Bye bye.